You want to know a secret for cash flow negative properties?
Welcome to Building Wealth Through Real Estate. If you invest or desire to invest in real estate, then this show is exactly what you need. And here's why. We all know that the number one thing that you should be doing as an investor is networking. Your network equals your net worth. But how can you use this to your advantage? Well, firstly, take notes. Listen to what the guests have to say. If you're a new investor, you can learn from the mistakes that they've made, the experiences that they've gone through, and learn how they think. If you're an experienced investor, you could see strategies that they may be implementing that you haven't thought of using yourself. Now, secondly, you may have questions, and if you do, great. Put them in the comment section down below, and this way we can be sure to get those questions answered for you. And thirdly, there's a ton of information out there, but I found that most of it is relevant to the US, and it's hard to try and take out and extract and see what's relevant to your area. So all of the guests that I'll be interviewing are Canadian investors. So if you invest in Canada, if you're interested in investing in Canada, then this show is exactly what you need. Joining us today is Mr. Keaton Kirkwood. Keaton, could you tell our listeners a little bit about yourself and where your real estate business is currently at?
Sure. So I'm a real estate investor. I bought my first duplex and converted it to fourplex in 2018 in Edmonton. And I did my second project very, very beginning of 2020, right around the corner of some fun times. And I'm also an investment-focused mortgage broker. So I specialize in helping simple clients buy their first home, but my primary focus is helping investors plan and build portfolios and ways that debt can be used to optimize someone's tax and investing situation. That's called the Smith Manoeuvre.
Okay, so I know from previous conversations that you currently focused mainly on growing your current business, but when it comes to real estate investing itself, what would be the next strategy that you'd go to pursuing?
So for me, I've got two fourplexes, and I find they're like sports cars. They have more cash flow. There's a little more output from them, but they're maintenance heavy. They require more effort managing your tenants. There's more tenant turnover or friction. Um, there's more work involved with keeping a fourplex running at kind of its optimal performance. The next project or properties I want to take on are going to be side-by-side duplexes on single titles, ideally when the property needs renovations, because I'm a big fan of buy a property that's 10 years outdated, where you can get reasonable rents and you can ensure yourself that you can get a decent tenant. Sure, you lose a little bit of cash flow, but if you get that bad tenant who trashes the place, who cares? You're going to do a full gut. So it's an insurance against that bad news. And I find in certain markets, I tend to like to invest in kind of C plus or B minus neighborhoods. It's a higher risk for me that someone's going to do damage to a unit. But long story short, the idea of buying those side-by-side duplexes, when I do my major renovations, finish the suite so it's still one unit, but rough in the electrical, the plumbing, everything I would need to suite the unit. So get it 80% to suited from a kind of, what's the right way, infrastructure perspective. And then that way I can subdivide at a future date. I can suite the property. I can sell it to another investor with, hey, this is a very turnkey fourplex. You just need to come in. But the idea that with those side-by-side properties, you eliminate the up-down tenant friction, and you can get those tenants. So a fourplex is a very transient type property. No one's going to live in a fourplex. Well, not many people live in a fourplex for 20 years. But side-by-side duplex with a yard, with a basement suite that's finished, you can get a family that ideally will live there for 15, 20 years. So what you lose in gross rents, you make up in, you're not painting every year and a half. You're not paying lease-up fees. You have no vacancy. So that's going to be my next project.
Yeah. You get a better tenant profile by just keeping it as a duplex versus a fourplex. Now, if I'm understanding correctly, you're basically saying when you buy these duplexes, you sort of delay the renovations for when you would need to do them, but you'll have the infrastructure to be able to create an up-down split as well. If there isn't that infrastructure, are you putting it in right then and there, or would you just delay that for when that time comes?
But what I mean to say is that whenever given the possibility, I wouldn't do major renovations up front unless I needed it to, let's say, get a bad tenant out, or it'll be situational. But when I do those renovations, I would put in that plumbing, that electrical, so it is ready to go. Because when you've got everything ripped up, the cost is, you might add an extra 10 grand of cost. To go back and redo it might cost 30 or 40 grand. Um, and it's a nice excuse if you need to make changes to the property. And I just enjoy that flexibility. I think as an investor, one of the best ways we can minimize our risk and downside is strategies like delaying those renovations so that you have an excuse to get a tenant out if you need. If they do damage the property, then who cares? You better believe you're still going to want them to be responsible for those costs. But if you are in a rougher neighborhood and you get a property that's 10 years old and could be renovated, but you're going to put 40 grand into renovations to get a $300 a month increase in rent, well, it's going to take a while to recoup that. So why not keep your cash on hand, have a better contingency, and then have that secondary insurance that, if you do get that rough tenant or they've got cats or whatever it is, you can renovate. And I think an interesting thing that you may find beneficial for some of your audiences, I mentioned cats. If you have that property that's 10 years old, you're going to get a $300 lift by renovating it. You might get a $200 or $300 lift by making it pet friendly. And if your plan is to gut it, who cares what the pets do?
I love that strategy. I feel like it's amazing. You're not putting all your capital up front. You put in some capital to acquire the property. You're letting it run its course until the time that you actually need to renovate it. It's less upfront risk as well with putting all your capital into the one property, but very future thinking. Now, when you are looking for these properties, when you do decide to go back out actively searching for these duplexes, would you be analyzing properties daily? I mean, I know with regards to your current work, you come across properties on a regular basis, but would you be personally going and seeking for these properties daily to actually analyze and see if there's something that would fit your scope?
Short answer is probably not. Depends on the market, but it's important to know. So I'm an investment focused broker, has been doing this for 8 years. I've got, I've worked with about 4,000 clients. I've got the network and the relationships where I don't have to. And an hour of my time put into my business gets a good return on investment. So I lean towards, I'm not looking for A+ unicorn deals. The reality is that my retirement strategy has real estate as a big component through my primary income as a mortgage broker. And I do invest in real estate. But for me, so as an example, if I just call my client base and I call realtors, I can fish for that deal I'm looking for while I'm doing my primary job, as opposed to, am I going to go with a realtor to open houses? And I don't mind paying a wholesaler 15 grand extra to get that good deal. It goes from an A+ deal from the wholesaler. They tack an assignment fee or a wholesale cost onto it. Now it's a B+ deal. I don't care. I'm getting a 28% return on investment. I don't care that it could have been a 35%. I can just wait. But that's the difference of even though I use active real estate investing strategy, I'm ultimately a passive investor in the sense that my primary career is working with real estate investors. Seeking deals is not my 9-to-5 day job. It's simply when my business earns enough money that I can invest it, I want to put it into real estate. And I think an important thing that investors should look at is, what actions are you taking? What is the return on investment to those actions? And is there a greater purpose? So an example, people who invest in the stock market. Some people have 30 grand to invest. They will get super passionate about it. They'll read about it every day. They'll look into, they'll look at Yahoo Finance 12 times a day. But best case scenario, they're going to earn an extra 3% return on investment. 3% on 30 grand, what's that? $900. My math even right? Yeah, $900. Is it worth it? Is it worth putting in 20 hours a week to get an extra $900 a year? Unless you want to be a stock trader or build an online profile of that or whatever it may be, the answer is probably not. And I think real estate investing is the same way. You have to know what your end goal is. And, if you want to do podcasts on it, you want to be a full-time real estate investor, great. You should do that. Whereas if your goal is passive income and building a legacy for your family and retiring, you may be better spent, and it's different for everybody, but you may be better spent focusing on your primary passions or careers. And I'm really lucky. I enjoy this stuff. So me doing my job is not something I want to get out of. I love it.
Yeah.
I get to help other people build a better future for themselves. And I get to learn others' mistakes and successes and hear about new strategies. And it's fun. So I think people should do that type of assessment, though. I come across many very active real estate investors, and, I ask them, why are you doing it? And are you enjoying it? And they're like, well, I want a better future for myself and my family, But no, I don't really enjoy it. It's stressful, and it takes a lot of time, and I'm away from my kids. I'm like, then why not just build the network that will bring you the deals? You'll go from a 32% ROI to a 25% ROI, but then you get to put your time and energy into what you care about.
I feel like return on investment is not the only factor to consider. It's return on your time as well, and how you can be using that time more wisely. Like if you're earning more, if you'd earn a higher return on your investment doing what you do on your day-to-day job, then maybe your time is better spent doing that and taking a bit of a hit on your actual investment itself. I think that's a great thing to consider, is not just your ROI on how much money you're putting into a deal and maximizing that, but how much time, how much energy and effort, and could it be better used elsewhere, whether it's with your family or on something else that you're passionate about. So I feel like that's a great way to look at things, not often discussed. Now, when you do come across these properties, through your network, how often would you find that you're actually going out to view them? Because I take it the way you would have it structured is different to someone just scrolling through listings and seeing, does this fit my criteria? No, move on to the next one. When deals come to you, they likely would be, or the chances of them being a better deal would be a lot higher, right? Because you're dealing with people who know what you're looking for. They know what a good deal looks like. It's more you just looking to see if that deal works for you. How often would you be going out and actively viewing these properties?
Well, it's important to note when someone brings you a deal, it doesn't necessarily mean it's a deal. It just means it's a deal they've got. So I'm always
For sure.
very skeptical and jaded when they come my way. But um, I find the problem with scrolling through MLS, let's say, is that if you're looking for something specific, great, you know what you're looking for. If you're just learning the market, great. But if you're just looking for a deal, but you don't really know what you're looking for, and you're just scrolling and scrolling, I don't think there's a lot of benefit there.
Yeah.
I think the benefit there would be, let's say you have your spouse with you and you scroll through, huh, this one's the same neighborhood as that one we looked at, go back, let's open up and you compare. They're on the same block. Why is this one $30,000 cheaper than this one? It's newer. And having that discussion, that like actually trying to solve, why is this property cheaper? Why is it more expensive? And maybe you come to the conclusion, maybe this one's a deal, or maybe this realtor's just overpriced. Maybe it's irrational sellers. Oh, this one's a legal suite, this one's not. Then your brain goes, oh, legal suite, maybe $20,000 difference, and you'll start to build more evidence to that as you learn. I think it's important that when you look through properties, you're on purpose. But I'm generally like, I will go to a property if I'm going to buy it. My first property I bought sight unseen and trusted people on the ground. My second property, I flew out to see it. Now I live in Edmonton, so it's a lot easier. Go see a property, jump in the truck. But I don't want to drive out to see a property unless I've already 80% sure I'm interested, right? Like, I look at hundreds of properties every month for work. It's, unless I'm curious about something, it's unique, it's quirky, it looks like an absolute hatchet job of a flip and I want to go look at it to laugh at it or something, occasionally I'll go out. But I'm a big believer of know what you want to put into the process of finding a property. For me, I want longevity, stability, and something not necessarily turnkey, but turnkey relative to what I'm looking for.
Okay.
In my case, like I want a side-by-side duplex. I'm probably not interested in something that's 2 titles, and I'm gonna have to go try to get the city to amalgamate the titles. Yeah, I don't care. There's enough of them out there that unless it's a unicorn deal, which case, why are they bringing it to me? I think everybody should ask themselves that. When you see a unicorn deal, why are they bringing it to you? Are they your best friend? Have you done a lot of business together? If it's just some random guy who's like, hey, I got a deal. It's a unicorn. It's an exceptional 80% ROI. Why are you showing it to me? I can't be at the top of your list. But I think it's important to have those systems in place that, you put energy where it's spent. I would rather put a very high degree of due diligence into 3 properties than to put a very broad, spread out amount of due diligence just looking for those 3. It's all about hours in the day, Elray.
That makes a lot of sense. And I feel like that can just help, that advice itself can just help people cut down on the time that they spend actively searching, but not really getting anywhere. And I feel like the more narrowed down you can have what you're actually looking for, the more specific you can be, the less time you can actually spend wasting and scrolling through looking at, oh, look at this property, or look at that property, kind of thing. And I like the approach that you have, is that unless you like really really sure about this property and you want to take it to the next, like you actually considering buying it, or 80% of the way, like you said, then go out and view it. um I like that approach. I feel like your approach is all about how can I make the most of my time as well, and how can I not waste time with doing stuff that's not really going to serve me. So, and like you said, I know you're very long term thinking with regards to your investment, something that's safe, and something that's more for the long haul. What advice do you have for people? You know, they're starting out, but they're in it for the long game, and they want to make the most of their resources and the finances that they have to maybe acquire as many investment properties as possible, but without over leveraging themselves, keeping themselves in that safe space, but sort of maximizing what they can. What advice do you have for them?
I think the best advice I can give anyone is, one, you need to understand the fundamentals of what you're doing. While I'm less involved with, say, looking for my own personal investment properties, that's because I've done this for a long time, and my every single day is helping people analyze their investment properties.
Yeah.
So I think you have to have a level of understanding. An example, I've been growing my business kind of in the online space and learning more. Um, Before I hired a social media person on a monthly basis just to administrate a lot of stuff, I paid them hourly to teach me how they did it and to coach me, because I can't manage someone doing something I don't understand. And I also don't think you can assess the risk of something you don't understand. So I think rule one is you should go see those properties. You should put the time into it till you at least have a functional understanding of, you should be able to articulate the pros of the investment you're looking at for at least 5 minutes, and the cons. And the one where people miss is they can go on for an hour about all the reasons why it's a great investment property. They can't give you 30 seconds on what the risks might be. So I think having that balanced approach is really important. Um, and then the final thing I would think is taking the time to build out a team. The reality is, even if you're a real estate investment expert, you're still going to need a lawyer, still going to need an accountant, may or may not use a realtor or a broker, but trying to find that one person you really, really connect with, that you would bet your kids that they're looking out for you and not their business, and then use them. Find that one person you truly trust, kind of like the Hand of the King, Game of Thrones type stuff,
Yeah.
and use them as a secondary screen to the other professionals and people you're working with. Because for every good person in any industry, there's 9 people that suck or just trying to pay their bills or whatever it may be, but they may not have your best interest at heart. So understanding the fundamentals of the market, understanding what it is, learning the pros and cons of any investment you take, and then trying to build out that long-term team where you truly, truly trust the people you're working with. And they're not just yes people. You know, they're going to say, this is a mistake. Get your head out of your ass. Like, no, don't buy this. It doesn't get you to your goals. It's too much for you, whatever it may be. Or maybe they need to tell you stop being a chicken shit and pull the trigger, right? It's different for everybody. But um, generally speaking, I'm very cautious of people that push. There are the
Yes.
occasional clients that need a nudge because they've analyzed and analyzed and analyzed and they want that nudge. But generally speaking, most of us can make decisions, and we should have people that advise and guide us rather than instruct us.
That is gold right there. I think there's a lot of good advice that you threw in there. Firstly, I completely agree with you. It's so easy to look at how things can go right, and all the benefits in any opportunity, right? Um, like a property, for example. But it's a lot harder to try and find what can go wrong. And if you can do that, you can sort of help better prepare yourself to see if you have, you know, contingencies, exit strategies, things that can sort of um, that things that can help in those cases, and then you can see if it's worth taking on that risk. But secondly, I love your advice on finding your power team. I think that will help you through any struggles that you have, any speed bumps that you have along the way. You can rely on these people who are experts, as opposed to spending hours and hours trying to figure it out yourself, trying to learn about a topic yourself. You can rely on experts and finding people that you trust. So I love that advice: is find one person. That's a little less daunting. You find one person that you trust, and they can sort of help you fill out the rest of your team. You know that they have good judgment, that they're looking out for you. I think that's a great approach, as opposed to just, hey, let's just quickly put my team together with popular people in this industry, and let's just go with that. If you have trust in them, you can leverage their knowledge, and you can feel safer at the end of the day. Um, I love that advice. And I know in previous conversations we spoke about, when you build in your team, is making sure that your team members work well together, so that they can all work within your best interest and get you closer to what your goal is. With all of that being said, I think that can help people avoid a lot of the big mistakes that can really impact their journey. You helping people on a regular basis, what are some mistakes that you see people make that really set them back when it comes to, in particularly, getting financing for the investment properties?
From a financing perspective, one of the biggest mistakes I'll see people make is they will often use private financing to grow beyond what they can actually hold. So they'll build a portfolio, they'll use bank financing, they'll usually get so far, they'll start to hit resistance. They won't hit a wall yet, but they'll hit resistance. So sometimes they'll switch strategies, they'll go to flips, they'll start using private loans, whatever it may be. They'll then grow some more. But at some point, they realize they have to stabilize what they have. Maybe some flips don't pan out, they get stuck holding something. And all of a sudden, they have a larger real estate portfolio they can qualify for, and then they get trapped. And all of a sudden, they can't make any changes to their existing bank debt because they don't qualify. They can't change lenders, they can't restructure, they get stuck with certain properties in privates. And it's all ultimately a result of not planning properly and also not accepting limitations. Like, yes, there are certain investing strategies that work really well for select people where you can take lots of risk and go aggressive with private, but it's not for everybody. And I think it's important that if you pick a strategy, you understand the strengths and weaknesses of it. What many people do is they'll start to, like, kind of like cooking and you're making chili, and you start grabbing things out of the cupboard, and they'll start to hodgepodge different strategies, different tactics, different types of investing. And they end up with this kind of just shit mix, and it doesn't always work well together. And all of a sudden they have a portfolio that isn't pulling in a common direction, isn't getting them towards their goals. They don't qualify anymore, and all of a sudden they end up with properties kind of bleeding them out. And I think the biggest thing you can do to avoid all of that is have a very clearly defined why vision, a why, what, when. That's not passive income. It's, I want $180,000 of passive income in 20 years so I can spend more time with my family, and I'm going to achieve that through a mix of, indexing, real estate investing, and growing a business, whatever it may be.
Okay, so if I understand correctly, does that mean that if from the start, before people go in and dive straight into financing a property privately, if they go ahead, should they be going ahead and seeing if they'd be able to qualify to actually refinance it if they need to? Is that what you're saying there?
Well, yeah, let's say someone's going to do a flip, or they're going to do some sort of creative strategy, and they're going to use alternative financing. It could be a vendor take back, an agreement for sale, private, doesn't matter. If one of their exit strategies is, oh, well, I'll keep it. Well, then you should be looking at, can you keep it with that private financing? And one of the things that people don't realize is private lenders are not comfortable. Many of them, at least, are not comfortable renewing. They don't want to renew. They're like, if Calvert Mortgage is an example, and I don't know their specific policies, but they primarily focus a lot on construction and flips. So yeah, you need to renew. To a lender like that, that's probably a warning sign that things didn't go right. And we see it quite often when I'm shopping privates around, and many people are stuck in these privates. They've exhausted the banking side. They're like, let's try to find a better private. First question I get asked is, what went wrong? And of course, we're trying to champion the deal. Well, what do you mean nothing went wrong, huh? And they're like, well, they're renewing a private. Like, they're looking for a private to pay out a private. Something went wrong. And we're like, yeah. So I think if one of your exit strategies or one of your possible outcomes is something long-term, you need to make sure that, do you have long-term options? And, if, oh, well, I'll refinance and pay out the private. Well, is that a likely outcome, and what barriers are in your way? Maybe you can qualify to refinance out of that private. But oh wait, halfway through the deal, you found another amazing deal, and the realtor got you excited about it. You bought that one. Well, maybe that one pushes you over the edge, where it eliminates the exit strategy on the first one.
And I think that just speaks to your previous point, is knowing what could go wrong, trying to pick out what could go wrong. And if you can pick that out, you could sort of address that before diving in. So making sure you have those contingencies in place. And I know it also speaks true to that saying that you like: slow is steady and steady is
fast.
Steady is fast.
Slow is steady, steady is fast.
Exactly. So tell me, if people are interested in financing their investment properties within a corporation instead of in their personal name, what advice do you have for them? What changes with regards to that?
Make sure that first of all, you need to have your why, because how you structure things is going to tie into estate planning. And if you haven't thought about your why, you probably haven't figured out, many of us are building our real estate portfolios for our kids, at least in part. How we structure things is going to tie into what that purpose is. If you have a company with $10 million of real estate and you die and your kids take it over, there's probably a $4.5 million tax bill, maybe $5 million tax bill that comes with that. And, it could be a little more, a little less, but multi-millions. If you haven't planned for that, odds are your kids don't have that money sitting in their bank account. All of a sudden, your entire portfolio gets liquidated. So understanding your why and having that clearly defined, and then connecting an accountant, the person structuring the financing, and if there is an estate planning aspect, having all three of those people connected with you at the center, working what is the best overall solution, not the best tax solution, not the best financing solution, not the best estate solution, but the best combination. Maybe, oh, hey, it's going to cost you an extra $1,000 a year in tax, but it's going to save $400,000 of taxes at the estate stage. Well, it's probably worth it. Even if you live 40 years, you're still up $360,000. Maybe a certain structure is better for liability or better for managing your assets, but completely eliminates all your financing except for with one bank. Well, hey, you want to know that. You may decide to still go with that structure, but you should at least be informed. There's nothing more frustrating when a client sets up a 3 or 4 corp structure, comes to me and says, I want to finance this. And I'm like, oh, there's only one bank that's going to do this structure. Oh, you don't fit with them. They've got a liquid net worth requirement, or they're a DCR lender, and what you're doing just doesn't fit. They're going to give you 60% loan to value. Oh, and now they're $8,000 into a corporate structure. And, it's like, we would have talked 6 months ago, we would have done this differently. So really connecting those professionals and having yourself and them understand what the long-term purpose is, not just I'm going to make money.
That's great advice, and that ties into what you also previously said with regards to finding a professional you trust and then building your team outward that way, just so that they have great relationships together, and they can sort of help come up with the best structure that support your long-term goals. Because every option has its limitations, but like you say, if you can understand the limitations, you can sort of better navigate through your strategy and optimize it for benefits that will suit your long-term goal. So I think that's gold. I think that's not spoken about enough, to be honest, because I think people are just hungry to take action and dive into getting as many properties as they can, or jumping into their first, second, third property. Just keep that wheel spinning. But if you set up the right foundation, it will just serve you much longer, or much better in the long run. Sorry. So that's awesome advice.
And don't get me wrong, when someone goes and buys 9 properties in a year, like as a commission-based mortgage broker, that's really good for me. But
right.
It's maybe not really good for them.
Yeah.
And it's all situational, but I think it's important to take the time and put the energy into making sure that, if you're ultimately investing in real estate for a set purpose, make sure you're working towards that purpose, as efficiently as you can.
Absolutely. Now, you being a mortgage broker, I have to ask this question, given the current state of the economy. But what factors should investors take into consideration when deciding whether to lock in or choose a variable rate?
It's an interesting one. So the first thing you need to do is figure out how much extra cash flow does your household have to cover rising rates. If you do all that math and you realize, hey, you've got $4,000 to put towards mortgage payments, and we look at your rents and everything, we translate that $4,000 means rates at 6.3%. Well, shit, like prime's 5.95 right now. Fixed rates are ranging 5.75 to 6 in many situations. You're right on the brink of that. That individual needs to very seriously consider, are they going to deleverage? Are they going to sell? Are they going to lock in? Um, because otherwise they may find themselves in a position where all of a sudden rates are 7%. It's not sustainable. Odds are if rates go up another percent, market values will decline, at least as an average across Canada. Um, and maybe locking in means, oh, you're going to lock in at 6.5. Well, if you can afford up to 6.3 on your tiptoes, like sure, maybe you'll bleed to death really, really slowly at 6.5. But do you want to lock in for 5 years or 4 years a number that you can't afford? And the other thing about locking into fixed rates is the penalties are often 5 to 10 times larger than variable rates. So if you lock in and then you realize you don't want to own the property, you can't afford it, something changes, then not only have you locked into something you can't afford, but now when you go to sell, maybe you're going to go from an $8,000 penalty to a $58,000 penalty. Well, talk about shooting yourself in the foot. And it's very interesting with everything going on. I'm actually putting some data together right now on the impact of rising rates and how much we need to see the market decline to offset that increase in rates. And what I found really interesting, I'm not fully done the kind of research on my end yet, but I use a baseline of a 2% rate and I use 6% as today. And we only need to see about a 9% decline in property values from a net worth perspective to break even over 5 years, which I thought was pretty interesting. But from a cash flow perspective, we need to see almost a 40% decline in values for the cash flow to be similar. So it's very interesting how rising rates are creating different opportunities depending on what your goals are. If your goal is long-term growth or net worth, you can afford to buy a property at a higher rate with less of a drop, but you're going to have to feed it. The biggest barrier to people is going to be negative cash flow. So there's going to be a lot of great long-term opportunity out there for good assets, but it's going to cash flow negatively, at least for the short term. Whereas if you're a cash flow investor, you're going to need to wait for a far larger drop to be able to justify the cash flow. But you're going to be potentially missing out on major opportunities. And I think that even myself, until I started doing this math, I was like, holy shit, I didn't know that there was this disparity where, property values might drop 25%. And I use $1 million property as the baseline in the numbers I'm calculating. So there's $250,000 off an asset. And I use the assumption, would you have bought it before rates went up for that original price? And so you're getting that same asset for $250,000 less, but at a 6% rate, which is tripling the interest cost. The interest cost might be only an extra, let's say, $100,000. So you're $150,000 up day one, even if you factor in the carrying cost of that extra interest for 5 years. And the last thing I'll end this with that's really interesting I found was I came to the conclusion that regular homeowners are disadvantaged by rising rates more than investors. And the reason for that is if rates go from 2 to 6%, the homeowner has to pay that full 6%. It's not tax deductible. The investor is going to get to write off that 6%. If they're at a 33% tax bracket, they essentially eliminate a third of that interest cost.
Yes.
So investors are actually impacted less by these rising rates. And I've got all the data crunched out. Now what I'm really working on is interpreting it and then translating it to something that makes actionable sense.
That is really interesting. With regards to the cash flow appreciation. So given what you're saying, it probably seems like a lot of people's strategy for the time being, at least, is going to be turned more towards the appreciation side than trying to find deals that cash flow, because I mean that's hard to find right now anyway, or harder to find right now anyway. And then also just to touch on if someone with the your original response there, if someone is essentially already underwater with regards to cash flow, would they, if they do have some reserves, would you then just recommend they stick variable for as long as they can in hopes that it comes down, as opposed to locking in and bleeding out slowly?
It really depends. If they've got the assets to carry that negative cash flow or the income to carry it, it's worth considering.
Okay.
The flip side's if the property's losing cash and maybe they can sell and they won't make as much money as they would have 6 months ago, but they'll still come out ahead. Is it worth managing that liability, which could get worse? Like, what if rates go up more and you get a bad vacancy or a tenant that can't pay?
Yeah.
Like, everybody forgets rising rates is essentially to trigger a recession. Everybody's focused on what if rates go to this or that, but what if there's a recession and 10% of Canadians lose their jobs and all of a sudden people not paying rent's a major issue and the tenancy boards or to evict people's backlogged? There's more to it than just interest rates. So I think it's very case by case. And also your exposure to real estate. If you've got $5 million in real estate, you've got 2 properties that are bleeding you out while everything else is doing well. Well, if you sell them and you've still got $4 million of real estate exposure, but you're eliminating your worst case scenario and you're exponentially improving the strength of your portfolio, I would say maybe you should sell. Whereas if it's your only property and there's still an upside, like there's so many ways you can dig into it and it's very situational. But to clarify on what you said earlier about, I'm not saying that people should speculate on appreciation. I'm just saying that I kind of use the fundamental argument or idea. Would you have bought the property at, say, 100% market value before rates went up? If that's true and you long-term believe in the asset, does it make sense to buy it at a certain increment or price drop? And personally, I'm okay with buying a negative cash flow property if it is a great AAA long-term asset. It's near schools, LRT's coming in, it's got a nice big lot, whatever it may be, but good long-term tangible benefits. I'm okay with feeding that property $3,000 a year or whatever it may be. But real estate investing for me is not, it is to build passive income, but it's to build passive income 30 years from now. And while I'm in my earning years, I'm okay with using my earning to supplement good long-term assets. My goal is not to create passive income to retire in 2 years. I'm realistic about it. That's not the best use of my time and my investment dollars. And many investors are learning, if you buy a dog shit property because it cash flows, well, if rates go up, it might not cash flow anymore. And now you own a dog shit property that's cash flow negative. And at the end of the day, if any property could become cash flow negative due to rents dropping, rates going up, whatever it may be, I would rather own a good property than a bad one. So it's situational, to say the least.
That's a great point that I don't think people always consider, because yeah, you're absolutely right, and I think a lot of investors are looking at real estate investing as a way to get out of their 9 to 5, as a way to create passive income and trying to get there as quickly as possible. And then of course with that comes a lot of riskier plays, right? So yeah, focusing just exclusively on cash flow is probably not the most ideal way to go about it.
Well, I'll clarify on it a little bit.
Yeah.
Most of us, when we invest, make an assumption that while we may not, I don't think anyone who's investing in Edmonton is investing on an appreciation play, at least like people do in Vancouver or in Toronto. But we still make an assumption there will be some degree of appreciation year over year, long term.
Yeah.
We often assume that rents will rise over time. And I think one of the interesting things and one of the pieces of my analysis I'm coming to is that Alberta's actually disadvantaged by rates going up. And it's kind of an interesting paradox. Rates going up is bringing market prices down in markets like Vancouver and Toronto. And that ultimately, if you believe in those markets long-term, is an opportunity. But those prices are coming down because costs are rising. And that is pushing people at record levels to Alberta, which is holding values steady. So that's then creating a higher interest cost with a flat price market. It actually sucks for us investing here. Now you have to start investing for longer term reasons there. But if I buy a really good, solid long-term asset today and it's $300 a month cash flow negative, and I know I have a 30-year timeline till the passive income really matters. Well, if I buy a really good long-term asset, it's reasonable for me to make an assumption it will appreciate gradually over time. The rents will rise over time. The debt will be paid down or reduced over time. And the last one is that if we're at, say, 6, 7, 8% interest rates and it's cash flow negative, I can do my research and make a reasonable assumption that I believe the long-term average interest rates will be lower. So if in 5 years interest rates are at 4.5% and I've paid down some debt and I re-amortize back to 30 years, I might all of a sudden have a cash flow positive property. I carried $3,600 a year, let's say, of negative cash flow for 5 years. Whoop-de-doo. If I got a AAA asset at a good price because the market sucked and no one else wanted it because it was $300 a month cash flow negative, I'm happy. It's still a cash flow positive asset in 5 years. It's just many people want their cake and they want to eat it too, right? They want that great AAA property, cash flows $1,000 a month. They want it today. And that's just not every cycle of the market.
That just shows the depth that you go into when considering purchasing a property. You're not just looking at the benefits for now. You weighing it out and willing to take the hit, take the loss now to get that bigger gain long term, to have a better quality property, get that cash flow over the long run. Take the losses now. How much time and effort do you actually go into calculating these possibilities and whether it's worth it?
Well, I don't put a huge amount of effort. Like, I'm lucky. I can use a finance calculator. So like I can literally like in real time, okay, I buy $500,000 property, 20% down. So that's 400,000, 300 or 30-year amortization, let's say 6% rate, 12 payments per year. So I come to at 6% interest, that mortgage is $2,400. I can go one input 60. Actually, I'm doing this wrong. Yeah, 160 shift amort. I can see the balance will be $393,000. Actually, no, hang on, that didn't work right. Of course, this demonstration doesn't go as planned. But it's as simple as, so I can tell the balance will be 370. So if I set that back to my present value, I use 4.5% interest rates. I can see my payment in 5 years at 4.5% interest. If I reamortize, would be 1870. So in 30 seconds, I can quickly readjust. I know what my debt level will be. Let's say I take a 5-year fixed. If I know I can carry that property for 5 years, I know what the debt level will be. Maybe I can run, well, what if rates are 4.5%? What if rates are 5? What if they're 5.5? But maybe I invest with the fundamental belief that in the next 5 to 15 years, rates will decline. It doesn't take long to check these things. And if I rate that property and it's a 10, a 10, a 10, a 10, and cash flow is a 4, it's negative $300 a month. Well, one, I'm not speculating because yes, it's cash flow negative, but overall, the property, my principal is still being paid down beyond that $300 a month negative cash flow. So I am still improving my net worth month over month.
Yeah.
Forgetting appreciation or anything else. I'm just simply needing to feed that business to get it off the ground. So I think that you can do this analysis relatively quickly, but it requires a deeper understanding of what your fundamental beliefs of the market are long term. Now, once again, if you're investing in a neighborhood that let's say you're investing in Northwest Edmonton where the LRT is coming through, maybe you're buying a nice large property. Maybe LRT is expected in 8 years, and it's a 100-foot wide lot. It's a rare one. You could subdivide it. It's a block from a school. You're 3 blocks from a major transit route. You start to get all these check, but it's cash flow negative. Well, I can start to stack the deck to make forward thinking assumptions. Well, I think the rents will rise when the LRT comes in. I'm within 300 meters of the LRT station. I am making a reasonable assumption that a developer would be interested in my very large lot to potentially to change zoning and build a higher density project. Well, I can start moving the needle in the direction of I can logically justify why I might be willing to feed a negative cash flow for a period of time. But it's important to have that thought process.
I like that. Honestly, I like that. It's. I mean, everyone says that real estate is a long-term game, but that is really long-term thinking. And it's not often that I have these sort of discussions with people where the approach is to be able to take the loss now and perhaps even get a greater gain than were you to go look for another property that's cash flowing from day one, kind of thing. It's a good mindset shift.
You want to know a secret for cash flow negative properties?
Yeah.
If you get the right type of mortgage product, you can re-access all of the debt you pay down. you can run calculations, and at the end of the day, this is a higher stakes game. But let's say that you find a deal and it's an exceptional opportunity. It's cash flow negative, and thou shalt never cash flow negative. Like, for whatever reason you won't do it, you can structure the financing to essentially make interest only payments on the property. And maybe an amortized mortgage is cash flow negative. You may be able to make it cash flow positive by structuring the debt to essentially be interest only payments. Now, there's drawbacks to that. You're not earning your principal pay down as a return on your investment because you're using that principal pay down to feed the deal. But there are ways that you can structure properties to essentially you're retaining the debt you would pay off. You're effectively making interest only payments. But if it's a solid long-term play that you're making, and it's not just the market's going to go up, but you've got more than that. There are ways that you can trade that short-term benefit for the convenience of not needing to feed that property. Now, you do increase your risks overall a little bit, and you need to make sure that you've budgeted for that. You've got the liquidity or the fallback to deal with, well, what if things don't go to plan?
Yeah.
But there are ways that when you get really into the levels and layers of this, you can take a property on paper that's cash flow negative, you could make it cash flow positive. Now, you're going to completely eliminate, say, your principal pay down. But once again, if it's fundamentally an exceptional long-term property and due to rates being above what you believe the long-term average will be, you can justify it in a way that may be practical investing. Or if you're investing in an area where you know transit's coming in and you have the data on the south side of Edmonton, when transit came in, rents went up 25%. Therefore, when transit comes in, I'm going to conservatively budget a 15% increase to rents. Well, you can start to really open up opportunities, and I think that's investing. I invest for cash flow, aka I look at performance from people, and if it's got a positive number, I'll buy it based on how big that number is. It's investing, but it's really shallow investing. Yes. Getting into the layers of what the long-term changes of the area will be and the economic drivers. Oh, I know that there's an Amazon warehouse in the area, and I know that they bought 400,000 square feet of land, and there's only 100,000 square feet of warehouse space there. I believe they're going to expand. Okay, well, if you do your research and that's the only piece of property Amazon's bought in the area, and they've said that Edmonton's going to be, let's say, a distribution hub, it's a reasonable bet. You know, you can even then get nerdier. Okay, well, they've got 100,000 square feet of warehouse space. How many staff do they have? Drive out there with some Tim Hortons, ask a couple supervisors, you'll probably get an answer, right? Okay, I know that there's 1,200 employees here for 100,000 square feet. You know, a little digging, call the city, whatever. Okay, so they could build 300,000 square feet of warehouse space. Okay, 3,600 jobs. You can start to really get into some really interesting ways to approach investing. And I enjoy these strategies when the market's slow, when it's not a good time to invest on paper. Because one, you're developing a better skill set where you'll get faster and faster at doing these things. You become more aware of factors that improve markets. And sometimes you'll make the bet without making the bet. You know, you'll pass on the deal, but you'll follow along what happens. You'll call your realtor, you say, hey, I want you to mark this property down for me. Whenever it buys and sells, I want you to notify me. You'll keep an eye on the area, the market. You'll see how that plays out, even though you didn't invest in it. And you'll get a little better at following, oh, okay, I know that when a warehouse expands and these jobs come, rents went up 10%. Well, it's anecdotal experience, but it can apply to other things as well. And that's the difference of a 40-year experienced investor versus a new investor, is that 40 years of experience. And many of the most successful people I work with say it's not the investment, it's the investor. And I think that's true in the sense that a very good skilled investor, and I'm not one of them, man. My first deal was spilling the chili. We got through it, and it was an okay deal, but it certainly wasn't what we thought we were getting into. And you get better over time. And a lot of what I'm saying and comes from my mistakes and really digging into them and applying and figuring out how I can improve. And my first property was a C- property for cash flow. I'm not talking down on people buying cash flow properties. I'm speaking from, I made at least to a degree a mistake. I've learned from it. What I'm sharing now is my current level of understanding and kind of awareness and my development. And I'm sure in 5 years, I'll be speaking differently. But it's that natural growth as a real estate investor.
But I think that's like deep investing, and I'm very interested in that. Honestly, I think oftentimes we focus on just the surface level stuff, and even if you look at an experienced investor, you know, you often don't see how deep they actually thinking and analyzing when making their plays. um, and then of course knowing your numbers, that's really important, but knowing the like understanding their strategy, and how intricate and how deep they think and how forward they think in, I think can just help you become a better investor and help you think on a whole nother level and view things through a different scope, which opens up a whole lot more opportunity for you for that long term play.
Well, there's different types of knowledge too. Like certain things you get really good at. I have a contractor buddy who's exceptionally good at doing flips in Edmonton because he knows the data of those flips. Now, the market data he knows specific to neighborhoods in Edmonton does not translate to other cities, but the cost and the knowing different layouts, the ability to know that with certain zoning rules, certain layouts are more cost effective. That may translate to other markets. The same goes for like a cash flow investor, just being a cash flow investor. That skill set of just, I know that I can find positive cash flow in Moose Jaw, Saskatchewan. Well, if your only metric is positive cash flow, other than looking for markets that are cash flow positive, this skill doesn't really translate. It's a pretty shallow skill. It's useful, but it's very one dimensional. The more layers you can add onto that, the better. Now, let's say you develop the experience, use the Amazon warehouse example that is totally imaginary. Maybe over 5 years of investing, you learn that, hey, whenever business comes in, you see for every 400 jobs created within a 300-meter radius, you see a 8% increase in rents. I'm making numbers up, but whatever you learn over time, you may all of a sudden develop a skill set where you've distilled a piece of data that you now go, oh, I've learned that anecdotally in 32 scenarios, whenever a job center came in, I saw a 2% increase in rents per 100 jobs. Well, maybe now instead of investing in one local market, you completely flip the script. You now throw your net out to look for jobs that are coming, breweries, distilleries, distribution warehouses, universities, whatever it may be, hospitals. And you look to catch, maybe it's the zoning level when permits go in to build your structures, anything that's 75,000 square feet or whatever it may be, and you try to just, you've thrown the lines out, someone says, hey, I just heard that a permit went in to build a hospital, and you quickly do your data. Oh, 1,000 hospital jobs. Well, my data out of 6 hospitals I've seen built, it looks like a 4% raise in rents. Well, maybe now you've identified investment opportunities that are unique to your skill set and knowledge in a market you know very little about, because you have a very broad universal skill set. Now, you're still going to do your due diligence on that specific market, but it can allow you to cast a wider net and specialize in something. And I'm just using one imaginary example, but that's the cool thing about investing, is that there's so many different opportunities and different angles. And at the end of the day, we make money as investors by solving problems. Sometimes that problem you're solving is just identifying the opportunity before anyone else.
Yes.
And then you make money off of identifying the opportunity, locking it down, and then offering that solution to other people. Well, I got it under contract before the pipeline was announced and the prices went up 30% because I saw that the permits went in 6 months ago, right? I saw that Shell opened up an office in Kitimat and started doing market research in the area and environmental studies 6 months before they announced the pipeline. Well, everybody's going to have their own niche, but the person who identified that 6 months before the market did is going to probably make a shitload of money, at least averaged out over many different investments.
Yeah. Oh, I love that. I honestly, I love that. Very insightful. It just um, opened up my mind to when viewing investment properties, is just taking it to a whole other level, just upping my level on how I analyze potential deals. So thank you for that. I definitely would be diving deeper into the economics behind it all, and trying to understand that on a better level. To dial it back though, for people interested in the BRRRR method, as a mortgage broker, what advice do you have for investors wanting to take advantage of this method to sort of recycle their capital?
The Burr method, my advice would be to make sure that you're structuring things to be as efficient as possible. Now, if you're expecting a lot of sweat equity, you may want to structure the mortgage in a way where you're going to go with lender A, you're going to do your renovations, you're going to break the mortgage and go to lender B so you can access that sweat equity. If you're more, let's say you're suiting a property, you're doing the Burr to add a revenue stream, let's say a secondary unit, while maybe you expect $20,000 of sweat equity, at the end of the day, you're using a general contractor and you're not going to get a huge amount of lift. You're not doing all the work yourself. It may be more efficient to go with a lender that's going to give you a product where you can pull your appreciation out without breaking the first mortgage, and ideally without triggering legal fees. That might save you $9,000, depending on the size of the deal, $8,000 of lost profit that you can just avoid by being more efficient. So I would say that understanding what your Burr is going to look like and what the reason you're doing it is it sweat equity and you're going to do all the work yourself and you're going to, you're going to take $50,000 of work, 3 months of your labor, and you're going to create $200,000 of lift? Well, you may want to structure it differently, or at least make sure you go with a lender that's going to give you market value rather than cost. Because what a lot of lenders are doing is cracking down on refinancing on properties under 1 to 2 years. So they'll look and see you owned it for 4 months and they'll make you provide the contract, or they'll pull the data to see what your purchase price was. And then they're going to say, why are you refinancing? You're going to say, well, I did a bunch of work. They're going to say, okay, show us receipts. If you spent 50 to increase 200, that doesn't work. But so I think it's understanding what you're doing, what the purpose is, and then making sure you go to the right lender. Like one of the lenders I work with doesn't care if you refinance in 3 months, 4 months, as long as you've got a good reason and you qualify, they don't care. They'll give you market value. And they also are a lender that has a readvanceable product where you can add, think of it like layers on a cake. Instead of destroying the first layer, which is the mortgage, and paying a penalty, we just add an additional layer on top. And that, let's say the sweat equity you created, you're not going to reinvest right away. Well, we can access that as a home equity line of credit where you get access to it, but you don't pay for it. Because if you're going to finish your Burr, get access to your money, and then it's going to take you 4 months to find your next deal, do you want to pay interest on that money at 5.5% for 4 months? Or can you save another $1,800 by having access to it and then using it when you need it? Now, hey, sorry, this cat hair is driving me nuts. Now let's say that, okay, you found that other property. If we structure things correctly, well, it's great you saved $1,000 or $2,000 of interest by having a home equity line of credit where you had access to the money but didn't use it. But home equity lines of credit are often prime plus a half. So that would be 6.45% today. Yeah. Now a closed variable mortgage might be prime minus 0.2. So now you can make a 0.7% spread on that down payment you borrow for the next deal if you can lock it in. So having someone who understands the layers of what you're doing, not only can they save you the penalty and the legal fees, not only can they save you the carrying cost on that money while you find your next deal, but then they can save you, let's say, a 0.7% spread on that down payment when you borrow for the next one. It all adds up. And that's the difference of someone who specializes in this stuff and really, really understands it and is an investor themselves versus someone who says, yeah, I work with investors. Yeah.
Exactly. And I feel like oftentimes people will nickel and dime in one aspect of the project and then totally ignore other aspects where they just losing money there. So I guess approaching your mortgage broker before doing all of this would save you.
Well, I would say the right mortgage broker.
Absolutely. And not just an investor focused mortgage broker, but an investor focused mortgage broker who invests themselves, right?
And I think one of the best ways you can vet professionals is do not ask, do you work with investors?
Mm-hmm.
Ask, hey, all right, when you're working with a client on a Burr strategy, what are the biggest risks? And as a broker, how do you help mitigate those costs? How do you structure the debt to be different? Well, you're going to know real fast if they know what a Burr strategy is, if they've ever thought about this, if they've actually well-versed at it.
Yes.
Like I do a lot of public speaking, a lot of panel type stuff. Like I'm very well-versed that you can ask me just about anything off the spot. I may not have every answer, but I'm usually pretty quick on it.
Yeah.
Because I do this stuff every day, all day. Whereas if you ask me about, a very obscure commercial financing question, not my specialty. I'll probably be able to point you in the right direction, but I'm not going to have a well articulated, tried and tested answer that's applicable. We're like, I don't know. Here's my commercial guy's number. But that's the difference.
Yeah.
But if you just ask, do you work with commercial lenders? Well, if I wanted the business really bad, I'd be like, yeah, I do. Whereas the open-ended question might flush out, I don't have a clue. But I'm curious, like you mentioned earlier about people micromanaging little costs. In South Africa, do they have a saying, penny wise, pound foolish? Or is that just in the UK?
No, I've never heard that one. No.
Yeah, so the idea of you manage your pennies, but you don't worry about your dollars.
Yeah.
I see a lot of people do it. They'll take a product, let's say a burr, that's going to save them 0.1% on the rate.
Yeah.
It's burr, it's short term. Maybe they only owe the money 7 months. So maybe they save $700 on the interest. Now they trigger legal fees for $1,500. They trigger a penalty for another $8,000. You really showed you were a smart investor, mister. You're only $7,300 in the hole, right? So but you can lead a horse to water, but you can't make him scuba dive, right?
I've never heard that one. Can't make them scuba dive.
There's an investor that I work with who wrote a book, and he likes to use that saying. But I think it's important as an investor that you are aware of what you don't know, and that you find the right people to place your trust in, because there's a very difference. So I'll use the example of a general contractor. There's a big difference between someone who has a skill level to professionally and effectively manage specialists that do electrical, plumbing, HVAC, all the very pouring concrete. There's a big difference between that general contractor who is an expert at managing everybody versus someone who can do all of those things themselves. And I think one of the biggest mistakes investors make is they try to do all of those things themselves. And, they say a jack of all trades, a master of none.
Oh yeah, for sure. Know your level, your level of competence, and then rely on experts for theirs. Because knowing everything, it's not going to get you very far. If you look at just in general, people with different positions, the people who specialize are the people who tend to make the most money than the people who know a lot of everything, right? A doctor makes a lot more money when they specialize than if they're just a general GP.
Well, I'm not that smart. I've just spent a lot of time learning about a very specific topic, right? Like that's the reality of it. There's a lot of stuff like construction. I don't have a clue. I call my general contractor buddy Ambrose, and he's the master of that. I don't need to specialize that. I just need to know who I got to call.
Exactly. Your power team is the foundation that you rely on. But I wanna touch base with regards to something that I've seen you've put a lot of effort into recently on educating people about, and that's the Smith Manoeuvre. For those people out there who don't know what this is, could you perhaps just summarize how the strategy works and the benefits that it provides?
Sure. So I'll explain this a few different ways, because different ways click with different people. The Smith Manoeuvre is a debt conversion strategy that focuses on eliminating non-tax deductible debt, typically on your primary residence, and flowing funds in a way that you pay down $1 of non-tax deductible debt using a certain mortgage product and a certain strategy. You then replace it with $1 of tax deductible debt. So you lower the cost of that debt by anywhere from 20 to 50%. And you also create $1 of investment. And the idea of the strategy is to flow funds as efficiently as possible to minimize taxes, interest, and to maximize long-term investment growth. What does that mean in the real world? Let's say already that you own a home worth $500,000 and you have a $400,000 mortgage on it. If we were going to set up the Smith Maneuver, we would set up something called a readvanceable mortgage. So as you pay down that $400,000, let's say for every dollar you pay down, there's a line of credit that has $1 added to the limit every time you pay off $1 on the mortgage. We can then allow you to reborrow any debt that you pay off and invest it for retirement purposes. It can be buying real estate, investing in a business, investing in the stock market. As long as you have the reasonable expectation of earning income, it's generally tax deductible. Now, where this gets interesting is you can start to, that's the core concept. But let's say you have $100,000 of non-registered investments and you have a $400,000 debt on your home that's non-tax deductible. With the right product, you can take that 100. So essentially, at the end of the day, you've got $400,000 of debt that's non-tax deductible and $100,000 of investments. Well, assuming everything lines up and someone's done the due diligence and it's all correct for you, you can take the $100,000 of investments, pay down the $400,000 of non-tax deductible debt, reborrow the $100,000, put it back into the investments. You now have $300,000 of non-tax deductible debt, $100,000 of tax deductible debt, and $100,000 of investments. So we've simply reordered things where you now get to write off the interest on that 100,000. Same debt, same investments, but a major long-term benefit. You're now going to eliminate, let's say, 33% of the interest on that 100 grand for the next 30 years. Another example, and this is one of my favorites, is called cash damming. You've got your $400,000 mortgage that's readvanceable, and you own, let's say, 2 rental properties. They rent for $10,000 gross rents a month. They cash flow zero due to rising rates. That sucks. But you could take your 10 grand in gross revenue every month, prepay the non-tax deductible mortgage on your home, reborrow that $10,000 of expenses, pay for your rental property expenses. Every year, so in 3.5 years, you're going to pay that $400,000 completely off using the revenue of your rentals, reborrowed and replaced it in a tax deductible way. So in roughly 3.5 years, you would get to write off 100% of the interest on that $400,000 just by flowing funds as effectively and efficiently as possible.
Wow. I feel like more people should know about this.
So there's a group of people in Canada that don't know about the strategy. There's a group of people in Canada that are aware of it and like, oh, the idea of paying down, of basically borrowing on your home to invest in the stock market. And then there's a group of people that really, really understand the strategy and all the nuances and the layers. An example, the cash damming. You can use the strategy where you're still going to pay off your mortgage in 30 years. You're not taking on any additional investment risk because you're not borrowing to go invest in Microsoft. You're simply flowing gross rental revenue, paying down your mortgage with it, then paying for expenses you're already going to incur. So you're not creating any new debt. You're not creating any new investments. You're simply creating tax deductibility. At the end of the day, if you still pay that mortgage off over 30 years, you're still paying it off in the same amount of time. But the difference is that maybe by year 4, you get to write off. I'll pull out the trusty calculator again. Let's say your interest rate 6%. You have a $400,000 mortgage. Your payment's going to be about $2,400 a month. Every 5 years, you're going to pay $113,000 of interest in your first 5 years. So if you're able to make that fully tax deductible and you're at a 33% tax bracket, you're going to save $37,500 in taxes by having made that tax deductible. Now, for anyone following along, is like, what? You're not supposed to get the whole strategy off us discussing this. This is just an example of $400,000 of debt being converted from non-tax deductible to tax deductible. Every 5 years, it could save you roughly $37,000 if you're at a 33% tax bracket. Now, your situation is different. You need to find what options are available to you. The strategy is not completely risk-free. There's certain things you need to be aware of. And I'll give an example. You take your $10,000 of rent from your investment property. You pay down the mortgage on your property. You emailed your broker. He said, yeah, your mortgage is readvanceable. Well, maybe you're with Scotiabank. You've paid the 10 grand down. Now you're waiting. Okay, where's my 10 grand? I got to pay my mortgage payment tomorrow. Scotiabank takes anywhere from 30 to 90 days for that line of credit limit to increase. Well, shit's about to hit the fan. If you don't have the money there, you've got $10,000 of expenses that you're going to have to come up with tomorrow. And all of a sudden you're looking at your credit card. Well, you're now in the negative. Maybe you're bouncing mortgage payments. So it's really, really important that if you do this type of strategy, 1, you investigate it. 2, you make sure that the benefits complement your situation overall and you understand the risks. And then 3, you make sure you implement it correctly and cautiously.
I know you've been discussing this a lot. So if you don't mind, when we're done with this, if you could just send me some links on where people can find out more about this, because I feel like it is quite an intricate, you managed to sort of dumb it down, I think. But I think in itself, though, there's a lot of intricacies behind it. And I think people need to learn a little more about this. I'm sure people have a lot of questions that they need answered with regards to what you just said. So where can people find out more about this? Will you just send me some links and I can just put that down in the description below?
Yep. I've been uploading. So I just did a big series of events. We did 5 events. We had the creator of the strategy speak on it. That was the main first event. We basically had the creator break down what it is. I spoke about kind of how you have to apply your long-term why and vision, a core piece of any real estate investor anyways, to the strategy. And then we had an investment focused realtor just talk a little bit about portfolio planning and how like cash damming works and how it would apply to portfolio. But then I created 4 sub events where I had a chartered professional accountant talk about how they implement the strategy and how it applies. I had a certified financial planner discuss how the strategy works, how they implement it. I had that realtor come back and go really in depth into portfolio planning. And then the last one was myself talking about the planning, the risk management, how it all works. So there's like 6 hours or more of stuff on there. So I'll send you, it's all on my YouTube. But if you're confused, as an example, I'll use a little bit of a brief story. I did 2 solo jumps in Alberta skydiving. Now, imagine, so the first thing, investing. Just like skydiving, we're always taking on risk. The key is to understand the risk and control it. If you throw yourself out of a plane with no training, no equipment, and no preparation, it's probably 100% fatal.
Yeah.
If you take the time to have the preparation, the training, the right people, there's people who've done 8,000, 9,000 jumps skydiving and they've never had an issue. So you can manage risk to the point you can repeat it over and over and over again in a successful way. It's important to understand that investing is not avoiding risk, it's managing and understanding it. But just like the skydiving example, there's a big difference. When I did my first jump, I had to do 8 hours of training before. So there's a difference between taking 8 hours to understand something that's important, that is managing risk and doing it well, versus imagine if I got to the place and the guy said, all right, it's easy. There's the parachute. Put it on, pull these straps. When you jump, pull this thing. By the way, if your chute doesn't open, pull this and you're good. And then I get on the plane and I jump out. I'm not going to, when I'm in the moment, I'm going to scream my head the whole way down and hope the parachute opens automatically because I'm not going to remember.
Yeah.
And it ties into what I said earlier. And you mentioned the slow is steady, steady is fast. When you're slow with something, you build competency. When you become competent with something, you become proficient and you're able to get better at it. You start to master it. When you master something, you become exceptional at it. When you become exceptional at something, you make a difficult thing look easy. And investing, the Smith Manoeuvre, analyzing properties, it's all practice. Like, you've ever seen a chef with the knife on the cutting board, and then you're like, oh, I'm going to go home and do that. And you're like,
cut your finger right off.
The difference is that they've done that for 2,000 hours.
Exactly.
You've done it for 20 minutes. And if you're looking at investing in real estate, you're looking at getting started, you're the knife. You're the guy with the knife going, I suck at this, and the carrots are all different widths. But if you do it consistently, a month later, you'll be better. A year later, you'll be better. If you find a passion for it and you do it 20 years later, you're going to be that master that everybody and regular people master things. Eventually it's going to be natural. It's going to be easy. It's going to be fun, stress-free. Shit's going to go wrong, but that's fine. You have the experience. You know how to manage it. You know how to budget for it. And I think that that's one of the biggest challenges that investors make is they get involved. It's tough. It's learning. It's uncomfortable. And they give up. And hey, if it's not for you, then that's fine. Don't do it. But if you really do want to do it, don't give up because it's hard. It gets easier.
I love that. I honestly love that because I feel like there's that fine balance. Like you said, you don't want to go too fast. You want to be slow and steady. But at the same time, you want to be working at a level that you still taking action, making progress. That doesn't mean slow and steady means that you don't have to put as much effort, as much time into it. But I think it's your mentality behind the decisions that you make, behind the actions that you take. So you might still be working on a high level, putting in the hours that you need to be doing, but the mindset that you have is not that I'm going to get rich quick. I'm going to make this overnight and I'm going to be sitting on a beach. But it's more long-term, getting your foundation in place, putting things together so that when you do get to that stage, your foundation is broad enough, it's solid enough that it's not going to come crashing down when things get bad or with one wrong move, you know. So I love your philosophy and your way of thinking. I want to say it's different. It's not common to what I've come across. And I honestly feel like we can sit for hours, hours and hours and just speak without even feeling and watching the time go.
It's a true bromance, Elray.
It is. It honestly is. But I'm sure after this, people are going to want to hear more about what you have to say. So, could you let the listeners know where they could find out more about you?
Sure. Well, the easiest way to get a hold of me, if you're over 22, probably, is Facebook. You can find me Keaton Kirkwood on Facebook, and that's one of the easiest ways to connect with me. I'm not at 5,000 friends yet, so I've still got room. Get in while you can. Another way is my website, www.kbmortgages.ca. So kbmortgages.ca. And then I'll send you my contact details you can share as well. But I'll share this in 30 seconds. Slow is steady, steady is fast. That actually came from, I was in the military when I was in my late teens. And one of the proficiency exercises you have to do is you get it's called a C7 in Canada, but it's a Canadian version of an M16. And you have a magazine, it holds the bullets, and you have to load 30 rounds in 20 seconds. And it doesn't sound too hard, but they make sure that the bullets are all in a pile. They're not nice and organized. And if you rush, there's a good chance, especially when you haven't done this, when you're new at something, you're not proficient. If you rush, odds are the spring that pushes the bullets out is very strong. And if you drop one and it goes bouncing on the ground, you're done. Almost a 0% chance that you're going to be able to do it in 20 seconds. So the mantra they gave us was slow is steady, steady is fast. If you just consistently try to load the rounds, instead of rushing, you just try to, like a robot, clockwork, you get faster and faster at it. All of a sudden, you can do it in 18 seconds every single time. And the idea is just like with real estate investing, if you're slow and consistent, you're not going to make mistakes, or you're going to minimize and avoid them. If you make a mistake and you're new at something, and that, you know, in the case of, let's say, doing a deal, that it's not just you failed the test, do it over again. It's now you're dealing with real world consequences. You're losing money. You're trapped in a deal. If that bullet bounces because you rushed and now you can't reach it, and all of a sudden, you know, you're going to miss your refinance, you can't get out of the private deal, the consequences can be very real. So if you do things slowly, correctly, with the right support and people around you, and you just do it consistently, and instead of rushing and trying to save $3,000 on your renos, you go a little bit slower, but you do it methodically and you don't miss things, you're then going to avoid those mistakes, and you're going to be far more successful, and you're going to become very competent at something. And long term, that's the difference of you go through and you renovate a project, and at the end, you know, everyone's like, wow, that was so easy. You had no mistakes. And you're like, well, actually, I had 5 mistakes. You just didn't see it because I noticed them before they were actually an issue. And I just changed my plan without even saying anything. And they're like, oh, what do you mean there was something wrong? And you're like, well, the difference is that you went through slowly. So, yeah, that's where that saying comes from. But yeah, I learned some skills that I still use to this day. Like every part of myself as a professional, as an investor, and just as a human being, I try to base all of my actions and choices on lessons I've learned, either myself or from others. And I don't just focus on the good of people or the bad. I think that every situation, every person, every interaction, every podcast you do, you can look back and, you know, many people make the mistake of they only focus on the good or they only focus on the bad. They say, oh, I did a flip. I made 40 grand. It's great. Go do another. Well, there's an opportunity that's lost there where, well, what mistakes did you make? How could you have been better? And learning from that, you're going to improve. The flip side is many people make a mistake and they just say, oh, it was a complete train wreck. I lost 20 grand. I'm never going to flip again. It's awful. Well, maybe there were wins. Maybe you overcame a big obstacle. It could have been a $60,000 loss, but you actually overcame that $40,000 hurdle and you did something amazing. But I think having that approach of looking at the good and the bad and weighing it and using it to grow and move forward, as they say, fail forward. You know, you never get good at anything without screwing up. Think of any sport, any skill, painting, you know, you investing, you get good by doing something over and over again. Personally, I don't believe anyone ever touched a piano for the first time and was playing Mozart.
No.
I don't believe it's ever happened in the history of humanity.
No, exactly.
You know, maybe someone learned quickly, but you still suck the first time you do anything, at least relative to someone who's mastered it.
So I think to sum it up, slow is steady, steady is fast, be consistent, and make sure you rely heavily on having a good quality power team. Get one person in and that you really, really trust, that's knowledgeable, that serves you in your best interest, and get them to help you put your power team together. I think that's some of the takeaways, because I mean you threw a lot of gold in there, but honestly, I want to thank you so much for bringing all the value. I know you're busy and you took time out of your schedule. You have a young one expected on the way, another one. So I honestly appreciate you taking the time out. And I am certain that we're going to do this again, so we can bring people more value. But yeah, thank you, Keaton. Honestly, I appreciate it.
No worries, man. I want to thank you for doing this podcast. I followed along through all the episodes, and just like everything we spoke about today, like you're getting better at this every single time. You're asking better questions. You're becoming a better listener, a better speaker. You're presenting yourself better, and it's awesome to see you grow. And I hope you're learning about real estate investing with this stuff as well. And I hope you keep at it, man. Don't give up.
Thank you for tuning in to Building Wealth Through Real Estate. If you're interested in learning how you can add additional units to your rental properties, then definitely check out this episode where I interview Nick. This is your host, Halray Noble, signing off.